Hello, welcome to the Capital Employed podcast. For this episode, we had the pleasure of being joined by Harry Walsh, who is the Investment Director at Tyndall Investment Management based in London. In this episode, Harry talks about the advice he's giving his private clients in this current economic environment, areas of the market he likes, and 2 London-listed microcaps he feels have great potential. I really enjoyed listening to him, and I think you will too. Before we begin, every so often we will be doing some write-ups about stocks from around the world that have piqued our interest. These will mostly be companies on the smaller end of the market cap scale that go under the radar of most financial media. So if that sounds like your cup of tea, visit capitalemployed.substack.com and add your email to the list. That's capitalemployed.substack.com. Okay, let's dive into this week's episode. Please enjoy my conversation with Harry. Hi Harry, thanks for coming on to the podcast. Can you provide a brief introduction of yourself and Tyndall Investment Management?
Of course. My name is Harry Walsh. I have probably been in the industry since 2003, formerly at Jupiter Asset Management, where I was for 10 years. After that, I moved to Rathbones and more recently a new firm called Tyndall Investment Management. I look after private clients, trusts and charity portfolios. That's probably me. And in terms of Tyndall Investment Management, it is a small firm recently set up with kind of 3 key areas in our business at the moment. We've got the private client side, which is an area that I'm part of, looking after private client portfolios. We then have the institutional funds. So these are institutional funds run by 3 fund managers in a global space, an American space and a UK space. And then the third part of our business is partnerships, run by a guy called James Sullivan.
The conversations you're having with your clients at the moment, what's the current mood like? Are they quite fearful at the moment or looking to invest more? What's the advice you're giving them?
It's not easy at the moment, I have to admit. I guess the first bit of advice I'd give them is just, not to panic. And I think that's a really important point for clients. And, when you're managing other people's money, what one thing that is really important is not to panic and just to sell out at the bottom. If we are hopefully nearing some kind of floor or bottom. But we've seen lots of bear markets and recessions in the past, and equity markets do come back. So that is probably the most important point to kind of get across to clients. We've seen this before, and I'm sure we'll see it again in the future. But panicking and getting out is historically the wrong thing to do. So that would probably be my first point. In terms of inflows and outflows, it's been actually fairly quiet. I mean, I would have expected probably a few more clients to phone up and panic. It's really important again to keep your clients abreast of what's going on. So constant dialogue with them, making sure for my clients, I've made sure that they've got at least kind of 6 months to a year's worth of cash available on their portfolios in case they need it, because who knows what will happen with inflation over the next 6 months or so. It seems to be a lot stickier than what we were anticipating, doesn't it? So I think it's very important to make sure they've got liquidity. And I've got lots of different clients. So obviously I've got clients who are young, who are still accumulating wealth, and if they've got any spare cash, I am saying, now would be, on a medium to long term view, this would be a good time to put money to work. But then again, on the other end of the scale, I've got slightly older people who are taking pensions and making sure that their income is sufficient for them. But on the whole, to answer your question, it's been fairly quiet. I haven't had a huge amount of people putting money into the market, because I think there is quite a lot of fear out there for another 6 months or so. But at the same time, I haven't had anyone taking money out, because after speaking to them, I think they all agree that now is probably not the best time. Having said that, I think there's a couple of clients who are buying houses, and that's typically where money tends to leak away from when clients buy additional houses.
For the younger clients, what are kind of their backgrounds and what kind of things would you invest in for them because of that longer time frame?
So it's an area that I probably prefer, but typically the younger clients who have got the money are more so in the tech space, and have done quite well in that area. Typically, the kind of investments that I would be buying for them, I mean, I would obviously have a rounded portfolio with lots of different types of stocks, but it would be dominated by growth stocks, because if you're looking for the long term, I think growth stocks are certainly now, after the pullback, are starting to look incredibly attractive. You're seeing companies that have got really good kind of growth projections. The downside risk is now kind of limited. And as I was trying to point out in my previous answer, been through these types of bear markets and recessions before, and growth stocks come out the other side quite strongly, if as long as they've got a low cost of capital, and there's a lot of companies in that kind of space, then they should do really well. So I think the younger generation, they like that. They don't need the income if they're accumulating wealth at the moment, and so growth stocks fit their portfolio quite well. And at the moment, I think there's a lot of really exciting opportunities out there.
Are there any particular sectors? You mentioned tech there. Would healthcare or
So kind of, yeah, growth stocks that have got low cost of capital, trying to limit the downside risk. It tends to kind of lend itself to kind of, as you say, healthcare, life science type companies. And actually, more recently, a company I've been buying into, with the oil price where it is there's some quite exciting oil and gas stocks out there that are probably off the radar a little bit to some of the larger institutions. Some of them have kind of cost of extraction of oil of about $16 a barrel. And if you've got oil prices now over 100, and kind of hard to see the prices coming down anytime soon, there's some great opportunity there.
so if we can jump into your portfolio, can you talk about two stocks that you feel have great long-term potential? What was the thesis for investing?
Yeah, absolutely. So the two stocks that I've been kind of holding, and I think have got really exciting long-term potential and even medium-term potential. The first one is a life sciences company. It's called Polarian. Now, this is a company that essentially brings the MRI scanner that you see in all hospitals around the world into the 21st century. What it does is it's a drug device combo. So you are polarizing, i.e., energizing an inert gas called xenon. The person then would inhale this inert gas and go underneath an MRI scanner. Now, once you polarize an inert gas, xenon, it basically makes the MRI scanner up to 1,000 times more powerful. And the kind of images that you receive from looking at kind of a person, it's focusing primarily on pulmonary disease. So think your lungs. So you're going underneath. So think much more recently, COVID, obviously. But before then, people who have asthma or breathing problems would just go through a very old school kind of test where their GP just going, breathing into a tube. I'm sure you would remember those days of breathing into a tube when you're having your checkup, and a GP would have no idea whether your left lung was working better or your right lung was working better, whether it was the lower ventricle or the upper ventricle. Nowadays, with Polarian, you can actually get an amazing images of your lungs working, and kind of green parts of your lung where it's absorbing the oxygen, red where your lungs are not working. And it's really transforming the way clinicians are looking at pulmonary disease, which is actually one of the biggest killers in the world at the moment. And certainly sadly with COVID over the last 2 years, it's coming into the forefront. So this is a company that needs FDA approval. So they've got their drug device combination. They have to submit what's called an NDA to a new drug application to the FDA. They did this back in September last year. Now, I don't think it's any surprises that the FDA were under a huge amount of pressure last year with a number of drugs and devices that were wanting to get regulated. Polarian did not get FDA approval. They got what's called a complete response letter, not because of the drug side. So most companies, when a new drug, when they're wanting to get FDA approval, normally fail because the drug side, there's an efficacy issue. As I mentioned before, Polarian, with its xenon gas, it's a totally inert gas. It's abundant around the world. We breathe it in all the time. So that was not a problem at all. But I don't think the FDA had a chance to kind of compare the machines that Polarian had in their new drug application. The new drug application, when they submitted it, they had a particular machine that polarized the gas. Now, obviously, a year later, Polarian are using a new improved machine. And the FDA said, well, how do we know that the new machine that you're currently using is the same as the machine that you used with the drug application that you submitted? Now, polarizing gas, it's kind of like boiling a kettle. Every kettle boils water at 100 degrees. And the CEO, Richard Houlihan of Polarian, that's kind of the analogy he uses. So Polarian have had to go back to the drawing board. They've had to prove that each machine that they use polarizes xenon gas at the same frequency. And they've done that. They've submitted their new drug application again at the beginning of January. And we will find out in September this year, so not much longer to wait now, 3 months or so, whether it gets FDA approval. And that's going to be super exciting because once it gets FDA approval, it can start selling these polarizers, which will sit next to MRI machines in a number of hospitals. There's currently around 20 machines already out there in research institutions in America. But once it's approved, it can start, selling these on a larger scale. And it's the razor type model whereby you have the sale of the MRI polarizer, but then on top of that, you have the xenon gas, which you're having to sell to all these hospitals for them to use. For me, it's very exciting because I think it just takes the MRI machine into the 21st century. Because at the moment, there are a lot of very expensive MRI machines out there that I don't think are being used to their full potential. If you talk to all the clinicians out there, pulmonary disease is a huge problem, especially with COVID. There's a Professor Gleason who works at Oxford University who is writing a lot of papers on this at the moment. It's currently actually the only way you can spot long COVID in people's lungs. So I think it's important that this gets FDA approval as quickly as possible so we can start progressing with not just pulmonary disease, because obviously when you're breathing in this inert gas into your lungs and then go underneath an MRI scanner, it doesn't just stay within the lungs. You're starting to see it move into kind of, the heart and possibly up into the brain. So it could change the way people look at most diseases at the moment. So for me, it's exciting. I'm also very excited about is an oil and gas company because with oil prices where they are, I think we can't ignore the fact that I think sadly there's been, well, not sadly, but there has been an underdevelopment in new supplies of oil and gas, and there is some exciting companies that are doing it responsibly, and I think that's important, responsibly. And there's a company in America called Zephyr Energy, Zephyr Energy, and they're based in Utah in America, and they are kind of a shale oil and gas play, and they don't affect any households. They're essentially in the middle of a desert, just outside Utah. They are roughly a 75 million market cap oil and gas company. There's two areas to their business. They've got their non-operated assets. So they've probably got, a small percentage in roughly 200, slightly less than 200 wells, which provides them about 40 to 45 million of net cash. which they are using currently to develop out what could be a really exciting new basin in America called the Paradox Basin. With the new kind of technologies that we now have in drilling, and what I mean by that is it's not just vertical, you can do kind of horizontal wells now. You can move the drill to start drilling horizontally. You can suddenly make a well that's historically might not have been economical to being very economical. Zephyr Energy did their first drill. It was called the 16-2 well in the Paradox Basin not that long ago, and it was a huge success. And they've been doing extended well tests, and the hope is that this will start producing oil and gas in the next kind of 12 weeks' time. It will get linked up to the Dominion oil and gas kind of pipeline at the beginning of next year. And that will provide further cash flow for the company. As I said, the non-operating wells, roughly 200 give or take, is providing more than 40 million of net cash for them. This Paradox first well, 16-2, should provide them roughly 20 odd million of net cash. And then they've got this very exciting 3-well drill program starting in Q3 this year. And each of those 3 wells are going to be probably roughly the same size, if successful, as the 16-2 well that they've drilled that I was talking about earlier. And so, as you can see, we've got a company that's not far off a 75 million market cap that could be producing well north of 120 million of net cash kind of starting at the beginning of next year. So for me, this is a very, very cheap stock. We're not talking about kind of offshore oil and gas where it's a huge risk. I mean, this is shale oil. They've got 3D seismic all over the area that they're currently looking at, the Paradox Basin. The oil is down there. It's I guess the risks are an operating risk, just the drilling, making sure that goes to plan, and obviously the sands. There is oil down there, but whether it's the sands are too thick to be able to extract it. But I still think that the risks are still quite low given where the share price is, and I think this is something that could be very exciting for the next year.
Thanks for sharing that one. I noticed you own just shy of 9% of the company.
That's right.
That's great. Have you managed to make a trip out there at all to see what's going on?
Well, it would be great. I would like to do that. It's obviously been a bit difficult over the last couple of years. I speak to Colin Harrington, the CEO, a lot. I probably, with my larger holdings, I probably have fortnightly calls with the CEO. He's obviously extremely bullish. They've kind of hedged out kind of 50% of their oil at roughly, I think it was just under $100 a barrel. So that provides a bit of defensiveness if we do see the oil price come off. For me, I can't see the oil price coming off hugely over the next 6 to 9 months. I mean, we've seen Saudi Arabia struggle, OPEC Plus struggle with keeping up with their production targets. With Russia now, no one accepting Russian oil and gas by close to the end of this year. That's a huge amount that we need to add on to. I think the setup for the oil price, sadly, is to remain fairly strong, robust. And Zephyr is kind of, they are very keen on being kind of custodians of clients' assets, making sure that, they're doing it responsibly so they don't flare gas. For example, a lot of people get concerned that when you're drilling for oil, a byproduct of drilling for oil is you have to flare gas. They're very careful about doing that. They've recently announced that they've put a crypto mine on one of their pads. So instead of flaring the gas, which would go straight up into the atmosphere, they in fact fix that gas to a hose, which then goes into a crypto mining station, which is essentially a big box next to the drilling pad, which mines Bitcoin. So that's another source of revenue that otherwise would have just been flared into the into the atmosphere. So no, it's very positive. I would like to get out there, as you say, at some point, maybe in the coming year.
I've noticed both the companies you talked about, they're at sub 100 million in market cap. Is that where you're finding a lot of value now in the small cap space?
I used to work at, as I said at the beginning, at Rathbones and Jupiter, and I had fantastic times at both those companies. As the larger the company you work for, it gets increasingly harder to get exposure to the what I consider the really exciting, companies, the unicorns that start obviously sub 100 million. But if you believe in their management and their process and what they're trying to do, then they can quite quickly get to 500 million and hopefully kind of up to that billion mark. And so yeah, I for me, I get much more interest out of the smaller companies that have much more kind of scope to double, triple over the years ahead.
So, if you could go back in time to when you first started investing and managing money professionally, what advice would you give yourself? Is there anything you would do differently?
Probably, I would be telling myself patience is probably something that people don't talk about enough, but it is key to investing. I'm not a trader going in and out of stocks. I look at companies and fundamentals, and if you believe in those fundamentals, you invest, and things do take longer than you expect them. I mean, Polarian, like I was talking earlier, they didn't get their FDA approval, and I don't think through any fault of their own. I think the FDA have quotas to meet and ran out of time, but they're still on track for this September. And equally, Zephyr Energy, I think, is a fantastic company. They are trying to get their drill rig locked down for Q3 this year. If it takes longer, retail investors will get frustrated. But still, you've got to look back at the company and their fundamentals, and I still think it will be a great company. So I think probably patience is key. Don't get out of stocks just because they're taking slightly longer to do what they say they're going to do. Because ultimately, I think the end goal will be you'll be rewarded.
Yeah, I fully agree. Okay, so where can listeners go to find out more information about you and Tyndall Investment Management?
Well, obviously the best place would be our website, so www.tyndallim.co.uk. That's Tyndall Investment Management im.co.uk, where you can see bios of myself and the rest of the people I work with.
That's great. Harry, thanks so much for coming onto the podcast. It's been a pleasure to listen to you.
A total pleasure.